Let's start with that, the cost of getting to net zero. What are you seeing there?
Well, look, I think it's an amazing time to be discussing this. So thanks so much for giving us the opportunity. What we're seeing is a tremendous amount of capital has been flowing towards addressing the carbon issue and addressing Carbonomics. And so to us, Carbonomics means thinking about what that flow of capital means in terms of developing innovation. You see today that countries from the US to China are all innovating, no matter the governmental pressures. It's actually environmental pressures, stakeholder pressures, and corporate pressures to come up with the best ideas. That flow of capital means that new ideas are coming at cheaper rates and that investors are taking notice.
Right, indeed. And so when you say investors are taking notice, Sheila, I mean, how much new money have you seen taken in this year, into sustainable funds? Give us a sense of how investors are reshaping their exposure on this front.
Well, I think the pandemic has been fascinating for the question of sustainable investing in ESG. I think if you look at the large institutional investors, at the beginning of the crisis, many of them asked me, is this the pause for ESG? Is this a pause for sustainability and climate? Because the crisis is overwhelming. In fact, what we found is that people more than ever felt a clear focus on ESG investing. And you saw that come not just from large institutions, but from retail as well, and from interesting areas. Many people think that sustainability is the focus of millennials or the younger generations. But in fact, during the pandemic in Europe, you saw a 100% increase in baby boomer adoption and focus on flows into ESG funds. So it's actually been quite a dramatic shift, and maybe it means that the pandemic has really given people time to step back and question what they value most.
Yeah, it does seem as if the pandemic has been a real testing point for ESG, and perhaps it's come out fighting well in its corner. Can I ask you about the role of passive funds here, Sheila? Because I think you've been making some pushes into some passive ETF businesses. A colleague told me buying a gold ETF in September. How does the role of passive, though, fit with ESG commitments and investors wanting to be more active in the types of exposure that they have?
Look, I think we're in the early innings of figuring out how ESG sits and sustainability sits across the spectrum of passive and active. In our view, both styles of investing have a role, and we include quant along that spectrum, have a role in people's portfolios. If you look at passive versus active, to our minds, really we've focused a tremendous amount of energy and work on the quantitative side related to ESG. It's not fully active, but it's not fully passive. It comes with a set of rules and a set of factors where we feel there's an impact based on our analysis and our history and the analytics that show us that those information tools and those statistics and that data gives us an insight and helps us provide an edge. But I think there's a real challenge on pure passive when it comes to sustainability over the long haul, and you see everybody trying to address that. I think the question of how indices are constructed, what pure market cap indices can do in light of the focus on sustainability that most investors have today, and where those indices need to be taken in the future is something that will be the subject of quite a bit of work. And that's why our spectrum within Goldman Sachs Asset Management has really been about the quant side, the ways that we can enhance and be more proactive in the design of a more indexed portfolio, all the way to our fundamental equity, pure traditional active portfolios, where we really try to go out and kick the tires. And we have cooperation across the spectrum there as well in our stewardship activities.
Yeah, and when you go out and try and kick those tires, Sheila, and you try and exert some pressure and to inquire about these businesses and what it is they're actually doing, how much they're taking climate seriously, what kind of data do you use, and do you have confidence in that data? A lot of people talk about how the data that is available is just not complete enough at this point.
It's definitely not complete enough. And for example, 71% of the ESG statistics we might all want only are about 20% populated. right now. So there's a tremendous amount of data yet to be had. And that's probably one of the key things that we talk about with managements. And we meet with thousands of managements a year. We have a stewardship team that serves our entire complex. So whether it's from fixed income to fundamental equity to quant, this team, when we speak to managements, thinks about it holistically. What information do we need, and how can we better serve investors, as well as actually help those companies to get better? What are investors looking for from them? And I think you really see an earnest effort on both sides. Many corporates come to us and say, as a large $2 trillion asset manager, what do we need to do? What is it you want to know? Which data set should we be providing? And that's an area where I think the upcoming, efforts and the focus on European taxonomy, as well as the focus on creating a standardization of those data points, will really come into the play of how we think as investors in the years ahead.